So let's continue to explore this financing need. Where does this all coming from? How can we estimate and then ultimately deal with this need in the future? So there is a ratio that we can calculate. It's called the self-supporting growth rate. Sometimes it's called the internal growth rate. And essentially what this tells us is how quickly can the sales of the company grow and the company be able to finance that entirely with profits. That is, when will our growth exceed our ability to pay from profits and then need external financing? So again, calculating the numbers, here's our formula. We can see that this growth rate is around 4.3%. So at 4.3%, if we grow less than that, then we wouldn't have to finance externally. Everything would be covered by profits. So let's see how we can apply and look a little bit further at forecasting then. Now we want to start to think about how do we apply all of this into statements. We need to forecast our operating needs. We need to choose a financing policy to use. We need to identify, is there any surplus or deficits in our cash at the end of the year? And then ultimately, we need to repeat this until we can achieve the plan that's the best plan for our company. So we'll start off with a set of a table that basically represents all of the ratios of our operating assets. So if we go down here, we see what we got: the operating costs, depreciation, cash, sales, all of those things, part of our operations. This all comes from our analysis, our ratio analysis of this company in 2018. Now, what we have projected, what is different across the board, you see all those numbers are the same. What we have projected is what happens if sales change. We predict next year 11.1%, then 8, then 5, then 5 again. So we need to calculate how this fits into our forecasted statements. And of course, it's pretty simple, right? To find the change in sales, you take the previous sales, multiply by 1 plus the growth rate. Same thing with inventory. So now we end up with these forecasted statements. These are operating statements, right? Operating assets, or operating line items, if you will. So we see how sales change, operating costs, remember they are roughly 90% of that. We have a ratio, all these ratios, we just multiply them out. We get our forecasted line items for our particular company here. And we can see that that fixed assets is changing, inventory is changing. All of these assets, all of our assets are increasing. We see that accounts payable is increasing. But the one thing you don't see here is long-term debt. Why is that? Because that is external. We're only looking at those things that change internally to the company. So how can we then predict forecasted free cash flows? Again, from our variables up above, we can calculate these ratios. We've seen them many times before. NOPAT, the net operating working capital, total operating cash flow, free cash flow, and our return on invested capital. So for this outcome, what do we see? Well, we see that the free cash flow actually is next year. They're predicting in 2020, we're predicting a negative free cash flow. Again, from operations, that's really not really good for us. It's just showing that we're buying more things, right? We're have more cash going out, and we do know that we have increases in capital here. So it does make some sense, but it does create, at least makes you wonder a little bit. Well, why is it negative? Couldn't it be? Could we do something to increase that? to increase the profitability of our company, so the free cash flow would go up. And of course, those are always questions we would ask. One of the things you'll note, it really doesn't matter what happens in these next years based on this data, our return on invested capital is always the same. It's always 8.5%. So again, the big challenge here is that 8.5% is less than the 10% weighted average cost of capital financing. So we basically have proven, I guess, over the next several years that we expect the value of the company to decline. So what is the estimated value out here or today based on the values of these cash flows, right? Of values of this. So our if you remember the basic format of this, how we want to find is this horizon value in 2023. We expect that to be $4,941. We need to find the present value of that. We find out the present value of these other free cash flows, right? Find the present value of those cash flows. The value of operations is roughly $3,682 today. There's no short-term investments. That gives us an intrinsic value of $36.82. Subtract out the debt, subtract out preferred stock. There isn't any. That gives us an intrinsic value of equity of $18.82, which says that estimated right now, our estimated value of the stock price is $37.60. It's currently selling at $41. So what that's telling us is that our prediction of the future is that this company is going to go down in value. It's going to go down in value, whereas less really by about 8.2%. What's the company going to do to fix this, right? That's the importance of this analysis. Here's our plan. Here's how we think it's going to affect our company in the financial statements. And then how do we think that ultimately affects the value of the company in today's dollars? In this case, we're thinking it's going to decrease the value. And of course, the market expects us to increase performance. So how can we do this again? How can we look at how are we going to improve this? Well, of course, the company needs to go back and review the variables, right? What can we do to make the company more efficient? What can we do to make the company more profitable? Those are the things that are going to increase the value of the company. Now, we could try to say, well, maybe we can reduce the liability, which might reduce some of the interest expense. But in the general, let's just say, given where we're at right now, how are we going to finance what we currently have? If we assume 10% regular dividends, no debt, no common stocks going to be used, interest rate still 8%. Again, it's based on the average interest. We need to ask the question. We have estimated an increase in asset size. How do we ultimately finance that? Or do we need to finance that? Is there an additional amount of funding needed? So if we subtract the liabilities and equity, subtract total assets from that, what we'll find out is either we need more money or we have extra money. So if we have a deficit, we're going to concentrate on getting some type of a short-term line of credit. Now, if it's very large, we may have to come back and reevaluate our strategic plan, our plans for moving forward. But if it's a surplus, we need to figure out what to do with this. Now, they suggest maybe we pay a special dividend. I think in reality, most companies would rather say, if I have a little bit of a surplus this year, let's invest that short term so that we can ultimately maybe use it again next year. Or maybe we take that money Now, if we have a line of credit already open, let's pay off the line of credit. Or maybe we just pay down some of our long-term debt so that we reduce the interest expense moving forward. So here's the income statement from our predictions here. And of course, you can see that we predict we're going to have $232 in retained earnings at the end. Dividends paid in 2020 is going to be $110. So that's our income statement. Excuse me. Excuse me. So when we plug the same kinds of data, then create a forecast of our 2020 balance sheet, what we're going to find out here is that our assets increase. Of course, we're predicting increase in assets, but our financing will rarely keep up with that. It will always be something different than what the asset base is. In this case, if you kind of think about what we talked about as far as the balance sheet, we need $7,100 worth of assets to run next year, and we have $6,800 to buy the assets to do that. What that says is we don't have enough. We have a deficit. We need another $298 here. So where do we get that? Again, kind of depends on the amount. But in this case, what we show is that we're just going to go out and we're going to get a line of credit for $298. That will then bring our liabilities and equities into alignment. So again, what do we do if we have a lot more? We need a lot more. Maybe we're going to have to go out and issue stocks and bonds. But this is assuming no, we're just going to go out, we're going to finance within our own capabilities at this point in time without going to that external market. Look forward to talking to you in the next video.